The expectation of the next FOMC meeting, which starts today, is that the Fed will not raise interest rates this time around, but that possibility does exist. In the next meeting, businesses have already had a rough go with rates going up over the last 18 months. It is the changing of the dynamics they have dealt with for a long time that is really giving them some angst at the moment. But what lies ahead for firms if, in fact, we do see at least one rate increase in the future? Nina Trentman is team leader for corporate finance with Bloomberg and joins us with more. Nina, great to talk to you again.
Yeah, thanks for having me.
Thank you. All right, so this time around, it doesn't seem like we're going to get a rate increase, but nonetheless, a lot of businesses are dealing with a lot of angst from all of the rate increases we've seen over the last year and a half.
Yeah, I think you're right. What we're hearing from market participants right now is that they're expecting the Fed to sit tight tomorrow when it announces its rate decision. Of course, this comes after multiple increases since the spring of last year and comes at a time when there is this question, okay, will we see another rate increase later this year, or might the Fed be done with hiking rates? What we've seen and heard so far recently from the central bank has been that sort of there might be more room for rate increases. Of course, federal decision makers as well as corporate executives are also now watching factors, not just including the inflation reading, but also things like the oil price that has trended north of $90 a barrel, and also impacts like the strike that we're seeing that is ongoing at Ford, General Motors, and Stellantis that could drive up inflation further. As you said, companies are already dealing with a significant jump in interest rates, comparing it to the levels that we saw prior to last spring. So the federal funds rating is currently between 5.5% and 5.5%. So that is a significant increase in costs that many businesses are dealing with. And depending on how well your business is doing and how much debt you have, you are currently more concerned, and others are still chugging along. Interesting was to see after Labor Day that we saw a lot of companies hitting the debt markets, including in investment grade, where we saw one day with over $36 billion raised in new investment grade debt. So on the higher rating scale, companies are still doing reasonably well and are okay with taking on higher financing costs, whereas on the more leveraged side of things, there is, of course, some concern that higher rates over time will force more companies into financial distress and also potentially into bankruptcy.
And then you have to throw in the fact that the term recession is still out there. And, you know, whatever the percentage is you say at the moment that we're going to see a recession or we're not, it's still out there. And that is, as a dynamic, probably has an impact on what businesses are thinking about and what they have to do in this economic environment.
Yeah, the R word has been out there for a long time. And if you go back to what executives and also what central bankers said a while ago, then the expectation was that we would be in a recession right now. But the data indicates we are not. There is this question as to whether the Fed will manage to drive down inflation and engineer a soft landing that reduces inflation without a significant recession. But it remains to be seen as to whether that is happening or not. The executives that I've spoken to in recent weeks sounded all reasonably upbeat for the fact that in the end there's so much uncertainty out there. Of course, we have seen companies reduce costs, reduce expenses. We've seen layoffs at businesses, but then still also job creation still holds up reasonably well. So it's a bit of a mixed bag right now, and depending on what your industry is and also how you've managed your maturity profile as a company, that influences your outlook for the future.
How much, with these rates going up, how much are we seeing companies have to factor in extra cost to their bottom line with these rate increases? I would assume we're talking, well into the millions of dollars, maybe even approaching billions of dollars, depending on the size of the firm and what you were all invested in at that point.
Yeah, interest expenses, of course, have gone up as a result of higher interest rates. Depending on the size of the business and the size of their debt pile, it's oftentimes dozens of millions or even hundreds of millions for large businesses. Of course, the companies oftentimes also hold a significant amount of cash. So we're seeing from the Fed surveys that corporates are still holding more cash than before the pandemic. So, of course, they're also generating higher returns on that cash that they're holding. But if you're looking at tapping the markets right now, if you want to refund, then for an investment-grade company, you're talking about sort of at least around 6% in coupon rates on a bond if you're highly rated. And then if you're sort of lower rated in the junk space, you're talking at least 8, 9, 10%. So, of course, that is a significant increase compared to what companies paid just over a year ago when they went to the market. And that is something that executives have to factor in and also are factoring in. So we're hearing from executives that while they're expecting some moderation on interest rates, maybe starting next year, some limited cuts from the Fed, the expectation is not that we will go back to the levels that we saw during the pandemic and even prior to the pandemic with interest rates at historic lows. So just money has a price again, and that also influences how companies think about deal making. It depends on how they think about investing in their businesses, and this term, the so-called hurdle rate, as in the rate that investments need to clear in order to be seen as sustainable and as profitable. That rate and that hurdle has just gone up for businesses because of the increase in interest rates.
But isn't there also the dynamic, and I've heard this from economists, is that, when the Fed has been putting these rate increases into play, it obviously takes a little time for it to actually work its way into the system. And I don't know how far along down that path we are at the moment in terms of all of the rate increases actually being an impact on the system. I'm wondering if we're still, we could be seeing still a couple of these quarter point or half point rate increases yet to come. And this pain, this impact that a lot of these businesses are feeling already may be multiplied still as we move forward later into the fall.
Yeah, that's a good point. That's, of course, one of the concerns around interest rates, that usually there is a lag effect between rates going up and then companies starting to see the impact because, of course, maturities, usually companies try to refinance at least 12 months and ahead of maturity. Therefore, the fact that interest rates are higher now might only impact them in a year from now if they have a refinancing that's coming up. So to some degree, there is this expectation that it will take a little longer for the full impact of these consecutive increases to feed through companies' balance sheets and to show their impact on companies' finances. And that's, of course, also a challenge that federal bankers are facing, just because they're seeing the inflation numbers every month, but they're only seeing the impact on corporates and on the economy on a quarterly and if not even longer basis than that. And so that creates an additional challenge if you're a member of the FOMC right now.
Is the expectation by a lot of the companies and the C-suite executives that the Fed probably has at most one more rate increase in it before it stops? And I ask that because earlier in the show, Mark Lopresti, who was our markets guest from Battlefin, said that he believes that the Fed could have two more rate increases in it before maybe slowing down. And so it makes me wonder whether or not there's still a little uncertainty as to what path the Fed is still going to have to take here.
Yeah. That's a good point. Like, one of the things is certainly that we're hearing one more increase to come. What I heard last week attending a CFO summit here in New York was that people expect the Fed to start decreasing rates sort of in the late fall of next year. So if you just look at the number of Fed meetings in between now and then, of course, there's more than one. But the expectation is probably that there's going to be at least one hike, and I guess we will see from the commentary tomorrow from the Fed how much more room they see for more, and also in how far they're thinking about oil prices and other more recent factors influencing their decision making. And
so a lot of what we may hear from Chair Powell tomorrow and what we'll hear from the Fed in the November meeting may kind of lay the groundwork for what we may see play out in early 2024 and a lot of the decisions that these companies are going to have to make, whether it be about tightening the belt even more, about potential layoffs. The belief, I think, was that once we turned the calendar to 2024, we were going to probably, slow things down and maybe start to see rates decline at some point later in the year. It still feels like we've still got some potential angst out there that we're going to deal with even early next year.
Yeah, that's very much, of course, depending on your outlook as a business and on your forecasts and also what your sort of revenues and what your order numbers tell you. In terms of impact on businesses, because you asked about that earlier, if we look at, for example, what ratings firms are forecasting, they're forecasting an increase in defaults until sort of the second half of next year, which would basically speak to this lagging effect that you described earlier. So I think to some degree, companies will have to closely monitor the signals that their businesses are sending to them and also keep a close eye on upcoming maturities, on any other financing needs that they might have, and see how they can progress in this somewhat uncertain period, given that there's all sorts of different signals that we're hearing right now.
All right. Nina, great to have you with us. Thanks very much for your time today. All the best.
Thanks for having me. Appreciate it.
You got it. Nina Trentman, team leader for corporate finance with Bloomberg. All right, take a look at what's going on with Wall Street at the moment. Dow Industrial Average has been down pretty much all through the trading session. Markets right now see the Dow off 232 points, 34,392. The NASDAQ is off 102. The S&P 500 is down by 27. Earlier in the show, we talked with Mark Lopresti, who is the co-founder of Battlefin, and we talked with Mark about what the Fed's path around interest rate increases may be, and as well what his thoughts were on how they may start to consider cutting rates.
Inflation is not in check. We had of course, the PCE and PCI numbers that came out last week, higher than expected. Energy, oil prices in particular, this is like the last thing that J-Pow needs right now is oil heading to $100, which, by the way, I think I said yesterday on another program, I think we could see oil hit 100. Things are just not going as planned, Dan. They're not going as planned. We're not going to get anywhere near the Fed's target rate if they raise another 25 and then start cutting. I still think we're not going to see cuts until probably mid to the end of Q2 of 2024.
And again, the markets are down right now. Dow Industrial Average is off 232 points, 34,391. NASDAQ is off 103. The S&P 500 is down by 27. Keeping an eye on oil prices. West Texas crude right now at the moment up almost 1.5%. in $92.82 a barrel. We will take a break. Back with more of Wharton Business Daily in just a moment here on Sirius XM 132.